First idea, Dana, the auto parts producer.
Yeah, they're very heavily involved in, of course, the auto business and supplying the major OEMs, so they're called a Tier 1 supplier. And they're also very involved on the electrification part of the transition of the auto suppliers, or automakers. They've suffered, of course, along with the OEMs, on two fronts, really. One is that the automakers are their customer, so there's been a lack of demand, so they haven't been able to supply given the lack of unit growth. And the other side is the inflationary side with their input costs and supply chain issues. So they've really been hit by both sides, Andy, and they're starting to come out of that. I participated in a conference call just last week, or 2 weeks ago, with them, and their margins are starting to rise again. You can almost feel the fresh air of a new cycle happening, and this company has earnings power, we believe, of between $2.50 a share and $3.50 a share. So it's $16 or $17, very good value. They produce a lot of cash. They have a free cash flow yield of over or in the mid-teens. So a very exciting company from a valuation standpoint, and we think that setting up a good place in the cycle.
JPMorgan Chase.
Of course, completely different. Here's a huge company, a big bank, producing also lots of cash. And we like that. But, you know, this company, like Bank of America that I talked about earlier in the show, has a lot of different franchises, and they're leaders in virtually every one of them. So their trading desk, their fixed income, their commodity desk, very strong. Anybody's looking to do any capital markets business, JPMorgan is a likely participant in that discussion, and of course as a lender. I think the market has really looked at the banks and overreacted a little bit to the possibility of a very deep recession. So recessions are part of a normal cycle, of course, but deep recessions are going to cut to the bone with regard to these banks. In other words, loan growth is going to fall off the table, and their margins are going to really dissipate because they won't have that outlet for their capital. So the chances of that, I think, are not that great. We, of course, have a very strong labor market, which I think is going to get in the way of a recession being deep or long. So we think that the banks are in good position here. As strong financially as they've ever been, partly through regulation and partly through self-regulation, but nevertheless in a very strong position.
The Economist magazine argues that we are at risk of a housing downturn, maybe even a crash in many markets, but says the damage could be limited this time, partly, I guess, because of regulation. Well,
partly because of that, but of course, coming off the 2008 experience in the United States, completely different experience than Canada went through.
Yep.
The loan-to-debt ratios are quite low. So people we have to see housing prices drop precipitously before it starts to affect the mortgage value, before the credit value of the mortgage is affected. So we don't anticipate that at all. Canada, I think, has a bigger issue in terms of the bubble being built in the Canadian real estate market, without question, because from 2008 to now, well, I say the last 15 years, housing prices in Canada have grown many-fold more than they have in the United States.
I wonder, will the government ever dare to tax the principal residence?
I think from a political standpoint, Andy, just don't touch it.
So tough, yeah. That's right. There would be a backlash. Lowe's, you like the look of this stock, pulling out of Canada.
They are, and I think a matter of scale, they just couldn't get traction in Canada that they needed to make it an economically viable opportunity. Of course, they own Rona, they own Dick's Lumber in Canada, but they've sold that all to a private equity group out of New York. The U.S. company is in great shape. Marvin Ellison runs Lowe's, and he was a former executive at Home Depot, and basically took the playbook from Home Depot, the expansion of operating margins, and has applied it at Lowe's. And we made the switch from Home Depot to Lowe's about 2 years ago, and it proved to be a very good, timely move for us because the expansion of the margins at Lowe's that Allison has implemented have really driven the stock price higher, and it's done actually quite a bit better than Home Depot.
Yeah, I'm looking at the 5-year return from Lowe's, more than 160%, whereas Home Depot, it's been 100% over 5 years. Not bad, but Lowe's is a lot better.
Yes.
Yeah. Okay, and interesting, another U.S. retailer, though, stumbling here. I'm thinking of Target quite a few years ago.
Yeah, well, earlier I talked about Walmart and said that I had some trepidation about the area. Consumer discretionary is tough because, of course, we're coming off a period of elevated savings rates. And people are saying, oh, the consumer is still in great condition. Well, they're eating through their savings. And ultimately, the objective of the Fed is to scare people into not buying. And that's not good for discretionary businesses.